The U.S. Treasury market is usually described as the safest market in the world. It is where governments, banks, pension funds, hedge funds, central banks, and money market funds go when they want the closest thing finance has to a risk-free asset. But underneath that market, there is a trade that has, at times, surpassed $1 trillion in gross exposure. Gross exposure, not capital committed or net risk. It is not a meme stock trade. It is not a crypto trade. It is not supposed to be speculative. It is a tiny arbitrage between a Treasury bond and a Treasury futures contract. And the strange part is this. The spread can be just a few basis points. But when you add repo financing, daily margin, futures convergence, dealer balance sheets, and leverage often modeled around 20-to-1, that tiny spread can become a source of stress in the most important financial market on Earth. This is the Treasury cash futures basis trade. And to understand it, we have to start with one gap. A Treasury futures contract is a promise to buy or sell an eligible Treasury security in the future. A cash Treasury is the actual security trading today. In a frictionless textbook world, the futures price should be linked to the cash price by a simple cost of carry relationship. Very roughly, the futures price equals the cash price plus financing costs minus the income earned while holding the bond, adjusted for delivery options. So if the futures price gets too high relative to the cash Treasury, there is a trade. Buy the cheap cash Treasury. Short the expensive Treasury future. Wait for the two prices to converge. At expiration, the short futures position is settled by delivering an eligible Treasury security. So, the two prices are pulled toward each other by market structure. That gap is the basis. The important idea is not the exact formula yet. The important idea is this. The trade is betting that two prices, which are mechanically connected, will eventually move together. That sounds safe, but safe does not mean simple, and it definitely does not mean unlevered. The standard version is called buying the basis. A hedge fund buys the deliverable Treasury security. At the same time, it shorts the related Treasury futures contract. Then it finances the cash Treasury through the repo market. In repo, the hedge fund posts the Treasury as collateral and borrows cash against it. That borrowed cash pays for most of the Treasury purchase, so the hedge fund may only need to put up a small amount of its own capital, plus futures margin and any haircut on the repo loan. This is why the trade can be enormous, not because the spread is enormous, because the capital required can be small. That is the first key lesson. The basis trade is a small spread trade, but it is usually not a small position trade. Why does this gap exist in the first place? One reason is structural demand. Many asset managers want Treasury futures because futures are liquid, standardized, and less cash-intensive than buying a full portfolio of physical treasuries. A bond fund, for example, may hold mortgage-backed securities, corporate bonds, or other assets, but still need to match the duration of a Treasury-heavy benchmark. Using Treasury futures can be a fast way to add duration exposure. So asset managers may naturally demand long Treasury futures. Someone has to take the other side. That is where hedge funds enter. They short the futures that asset managers want to buy. Then, they buy the cash treasuries needed to hedge that short futures exposure. In effect, the hedge fund becomes a warehouse. It holds cash treasuries on balance sheet, funded through repo, and passes the duration exposure to asset managers through futures. This is why the trade is not just a casino bet. It can improve market functioning. It connects demand in the futures market with supply in the cash treasury market. It can narrow price dislocations. It can add demand for treasuries. And it can help keep futures prices aligned with cash prices. But that helpful function comes with a cost. The warehouse is leveraged. Let's make the math concrete. Suppose a basis trade can earn 40 basis points before costs. That is 0.40%. On $100 million of treasuries, that is $400,000. But if you had to use $100 million of your own capital to earn $400,000, the return is not very exciting. So the trade depends on leverage. At an illustrative 20-to-1 leverage, $100 million of exposure may require roughly $5 million of equity capital. Now, the same $400,000 of gross spread is not 0.40% on equity. It is 8% on equity before all costs, losses, and operational frictions. This is the heart of the trade. The basis is small. The leverage makes it worth doing. But the same equation works in reverse. If a small spread can be amplified into an attractive return, a small adverse move can also be amplified into a liquidity problem. This is not a theoretical corner of the market. Research by Daniel Barth and R.J. Kahn finds that the Treasury cash futures basis trade has, at times, surpassed $1 trillion in gross exposures. That phrase matters. Gross exposure is not the same thing as net capital at risk. They also find that basis traders consistently account for more than 60% of all hedge fund Treasury positions and about 70% of all hedge fund repo. A Federal Reserve note gives another lens. Between early 2018 and mid-2019, hedge fund net repo grew to a peak of roughly $598 billion, suggesting the basis trade grew by a similar amount during that period. After March 2020, the trade shrank. Then it reemerged. By September 2023, the Fed's comparison of public and regulatory proxies suggested basis trade volumes between roughly $260 and $574 billion. The lower end came from a trace cash market proxy. The upper end came from hedge fund net repo. The point is not that every estimate is identical. The point is that multiple independent lenses tell the same story. This is a large, leveraged, recurring structure inside the Treasury market. And because the trade sits across three markets, cash, treasuries, futures, and repo, no single public metric captures the whole machine perfectly. That uncertainty matters, because when leverage builds in a partially visible system, stress can travel faster than the data. A common misunderstanding is that convergence trades are risk-free. They are not. They may be expected to converge by expiration, but the trader has to survive until expiration, and survival depends on funding. If the futures leg moves against the hedge fund, the clearinghouse requires variation margin. That means cash today. If repo rates rise, the cost of financing the Treasury increases. If repo lenders demand more protection, haircuts or collateral requirements can increase. If Treasury market liquidity deteriorates, selling the cash Treasury becomes harder or more expensive. So the real question is not, will the basis converge someday? The real question is, can the trader finance the position long enough to reach convergence? In leveraged arbitrage, being right eventually is not enough. You need enough balance sheet to stay alive while the market is temporarily wrong. March 2020 is the stress test everyone studies. During the dash for cash, investors around the world sold treasuries to raise dollars. The Treasury market, normally the deepest market in the world, became strained. It is important to be precise here. The basis trade did not single-handedly cause March 2020. That would be too simple. There were broad Treasury sales from many types of investors, but research and regulatory analysis suggest that basis trade unwinds amplified the stress. CFT. C material summarizes the evidence carefully. Hedge fund and other leveraged investor basis trade sales are estimated in a range from $35 billion to $173 billion, while other sources of selling were also large, including foreign institutions and bond funds. Barth and Kahn estimate that hedge funds sold more than $200 billion of cash treasuries and reduced total treasury exposure by $430 billion during the middle of March 2020. They also estimate that nearly half of hedge fund treasury sales in March 2020 were attributable to the basis trade. That distinction is crucial. A good market structure video does not need a villain. It needs a mechanism. The mechanism is this. Highly leveraged funds can provide liquidity in normal times. But if funding costs rise, margin calls increase, or risk limits force deleveraging, the same funds may have to sell treasuries into a falling market. A stabilizing arbitrage can become a pro-cyclical seller. The micro-evidence is especially important. Barth and Kahn use transaction-level repo data and regulatory hedge fund data to show that at the peak of the stress during the week of March 11th, The repo rate spread for large basis traders increased by at least 30%. They also find that tighter financing constraints and higher repo spreads were associated with more Treasury sales. This is the basis trade's weak point. The trade is not just exposed to price risk, it is exposed to funding liquidity. And funding liquidity is not constant. It can disappear exactly when everyone needs it most. This is the feedback loop. Higher stress raises funding costs. Higher funding costs reduce the return and survivability of the trade. Some traders unwind. Unwinding means selling cash treasuries and buying back futures. Those flows can widen dislocations. Wider dislocations create more mark-to-market pressure, and the loop continues until enough balance sheet, central bank liquidity, or market confidence stops it. Let's strip the trade down to the core math. Assume a hedge fund has a $100 million basis position. For this simplified example, it uses 20-to-1 leverage. So the equity supporting the trade is roughly $5 million. Now imagine a small adverse mark-to-market move. Not a crash. Just 25 basis points of adverse movement on the notional. That is 0.25% of $100 million. The dollar loss is $250,000. On the notional, that looks small. On the equity, it is 5%. At 50 basis points, the equity loss is 10%. At 100 basis points, it is 20%. This simplified table is not a full risk model. It ignores convexity, delivery options, collateral treatment, futures margin offsets, and hedging details. But it shows the basic danger. Leverage changes the unit of measurement. A move that looks tiny on the market can be large on the capital stack. The profitability of the basis trade is not just the visible gap between futures and cash. A cleaner version is net carry is approximately the basis minus repo costs, margin funding costs, transaction costs, and delivery-related frictions. If the basis is wide, the trade looks attractive. But if repo financing becomes expensive, or if margin needs increase, or if liquidity disappears, the net return can vanish. This is why a trade can look profitable in a spreadsheet and still become dangerous in a funding shock. The spreadsheet assumes continuous financing. The market does not promise it. The basis trade is not just a price trade. It is a financing trade. And financing trades are always about the price of balance sheet. At this point, it would be tempting to say, basis trade bad, leverage bad, hedge funds bad. But that is not accurate. The basis trade can provide real benefits. Regulatory materials recognize that participation in basis trades can improve liquidity, narrow price dislocations, support market depth, and help align futures and cash treasury prices. The ECB describes basis trades as arbitrage strategies that can improve market functioning and, in principle, have a beneficial impact on market efficiency and liquidity. The problem is not the existence of arbitrage. The problem is the fragility created when the arbitrage depends on large leverage, short-term funding, and continuous market liquidity. A machine can be useful and fragile at the same time. That is the correct framing. Why does the trade keep returning after stress episodes? Because the structural forces behind it do not disappear. The U.S. Treasury market is enormous and still growing. Asset managers continue to use futures for duration exposure. Dealers face balance sheet costs when warehousing treasuries. If cash treasuries are cheap relative to futures, and if repo financing is available, hedge funds have an incentive to step in. The trade is not a one-time anomaly. It is a recurring response to structural demand, balance sheet constraints, and the relative pricing of cash bonds and futures. The cycle is simple. A basis opens, arbitrage capital enters, leverage builds, the basis narrows, then a shock tests the funding structure. After the shock, positions shrink. When conditions improve, the trade comes back. Not because everyone forgot the risk, because the incentive is still there. Modern regulators are not blind to this. The Federal Reserve has noted that high hedge fund leverage partly reflects elevated Treasury cash futures basis trading activity. Its March 2024 Fed's note introduces multiple ways to estimate the trade. Form P/F, hedge fund Treasury holdings and repo activity, futures positioning, and a near real-time Treasury trace proxy. The OFR Hedge Fund Monitor also tracks repo borrowing. In the fourth quarter of 2024, hedge fund repo Borrowing declined 9% quarter over quarter to $2.5 trillion after 8 consecutive quarters of growth. But the OFR also noted that from the fourth quarter of 2022 through the fourth quarter of 2024, hedge fund repo borrowing more than doubled, and that growth was primarily connected to cash futures basis, cash swap basis, and yield curve trades. A later New York Fed speech adds another monitoring lens. In March 2025, leveraged funds' notional short Treasury futures positions with maturities up to 10 years stood around $1 trillion. But again, that is a rough proxy. Short futures can reflect the basis trade, but they can also reflect directional positioning or other relative value trades. The New York Fed noted that estimates of the total basis trade volume tend to range from roughly $600 billion to $1 trillion. Again, the right interpretation is not panic. The right interpretation is monitoring. When the trade is well-funded, well-margined, transparent, and supported by robust market depth, it can help the market work. When the trade becomes too large, too levered, too dependent on overnight funding, and too crowded, it can amplify stress. The same trade can be both lubricant and vulnerability. So the full machine looks like this. Asset managers want long Treasury futures. Hedge funds take the short futures side. To hedge that short futures position, hedge funds buy cash treasuries. To finance the cash treasuries, they borrow in repo. If the basis converges, the spread becomes profit. But if stress hits, the machine reverses. Futures margin calls require cash. Repo funding becomes more expensive. Dealers may become more balance sheet constrained. Hedge funds reduce positions. That means selling treasuries and buying back futures. The unwind can widen dislocations and reduce liquidity, and the machine that normally connects markets can transmit stress across them. That is the hidden math behind the Treasury basis trade. It is not a simple arbitrage. It is a leveraged bridge between three markets: cash treasuries, Treasury futures, and repo financing. When the bridge is stable, it improves market efficiency. When the bridge is overloaded, it can shake. The Treasury basis trade teaches a deeper lesson about finance. Risk does not only come from bad assets. Treasuries can be high quality. The arbitrage can be real. The math can be logical. And the trade can still create fragility, because the danger is not only what you own, it is how you finance it. A $1 trillion trade built on a few basis points is not automatically a disaster, but it is also not automatically safe. It is a machine. And machines depend on their weakest parts. In this case, short-term funding, margin liquidity, dealer balance sheet capacity, and the assumption that convergence happens before capital runs out. That is why the safest market in the world can still contain one of the most important hidden trades in finance. And that is why, on Quantly, we do not just ask what the price is. We ask what mechanism makes the price possible.